Have you ever wished you had a printer where you could print your own money? I'm sure that most everybody has, and you're probably thinking that's just not possible. But I have something that's pretty darn close, and you don't even need toner or printer cartridges. It's an option strategy called the Wheel of Fortune, or the Wheel for short. And in today's video, I'm going to show you exactly how to trade it like a professional, step by step. Hi, I'm Andrew, and I've been trading options for over 25 years, and I am convinced that options are by far the absolute best way to generate consistent above average returns. On this channel, I release my portfolio performance update each week to document my success with options trading. One of the strategies I use is the Wheel of Fortune, or the Wheel, which is a simple yet powerful strategy. Not only is it a great way to learn about options trading and get accustomed to their complex dynamics, it's a great strategy to include in your arsenal even if you're an advanced trader. In a previous video, I did an introduction to the Wheel of Fortune, which is linked in the description below. In this video, I take a deeper dive into the strategy and show you how to trade it step by step like a professional. But even though it's a powerful strategy, there are some potential pitfalls that you need to be aware of, and I uncover those pitfalls and show you how to put safeguards in place to help protect you from those potential pitfalls. One last thing I want to mention is that if you're new to options, you'll want to check out my demystifying options video, which is linked in the description below, so that you can gain a basic understanding of options concepts. Now I know you're probably pretty excited to get started, so let's hop on in. So I'm going to use the stock chart of Boeing to do a demonstration of the basic Wheel of Fortune strategy. So as we can see here, Boeing is trading, we're going to call it $184 per share. And so we decide to go ahead and start trading the strategy on Boeing. And we do so by selling a put. And we'll go ahead and sell the put here at $183 strike price. And by selling this put, we were able to collect a $2 credit. And remember, because options contracts control 100 shares of the underlying stock, we multiply the $2 times 100 to get a total credit of $200. And so then we wait to see what happens to the stock, and at the end of the expiration, or when the option expires, we see that the stock price closes at $185 a share. It's above the strike price, which means it's out of the money. So when an option expires out of the money, that means we get to keep all of the credit collected. So we get to keep the $200 from selling that put. So then we go ahead and sell another put, this time to get a little bit closer to the stock price since it's gone up a little bit. We sell a put at a $184 strike price. And this time when we sell the put, we're able to collect $1.75, which means we get another credit of $175. And then we go back to monitoring the stock to see how it does. This time it actually drops down below the strike price, but by the time the option expires, it's back above the strike price, closing at $185 when the option expires. So even though the price of the stock did go in the money for the option, since we still had some time before expiration, the option did not get exercised, and when the stock closed above the strike price of the stock, again, the option expires worthless, and when an option expires worthless, we get to keep our entire credit. And so we'll go ahead and sell another put here, again at $184 strike price, and this time we're able to collect $1.80. So that gives us a credit of $180. And so we'll go back to monitoring the stock price, which rises, but then by the time the option expires, it is in the money because the stock price falls to 183 when the strike price is at 184. That puts the option in the money. This gives the option owner the right to sell the stock to you at $184 per share. And since the fair market trading value of the stock is currently $183 per share, they can make a profit by doing that. So they are going to exercise their right to sell the stock to you at $184 per share. Now the good thing is, even though you are being exercised and even though you are being forced to buy the stock at a price higher than the fair market value, you still do get to keep the entire premium that you collected when you sold the put. Now if we do some math here, we can see that the entire amount of premium collected so far for this trade is $5.55. So if we take the purchase price of the stock of $184 and subtract out the premium received so far during the course of this trade, we can see that our cost basis is $178.45. So even though we had to pay more for the stock than what it was currently trading for, we are still well below the current trading price of the stock. Now what we can do, now that we own 100 shares of Boeing stock, is we can sell calls against that stock. So we sell one call at a $184 strike price when the stock is at $183 per share. And when we do that, we're able to collect $1.50 or a total premium of $150 and wait to see what the stock does. And so the stock ends up closing back at $183 per share, which is out of the money because it is below the strike price of the call. And when an option expires out of the money, we get to collect the entire premium. So we keep the $150 and we sell another call. This time we collect $1.60 for selling the call, which is a total premium of $160. And we take a look to see what the stock does. And this time when the option expires, the stock is above the call, which puts the option in the money, which means the option owner is going to exercise their right and they are going to force you to sell the stock at $184 per share when it's actually worth $186 per share. So that's something that the option owner will take advantage of. But again, you do get to keep the entire premium collected. And you initially might think that this is not such a good deal that you have to sell the stock for less than what it's worth. The stock is trading for $186 and you have to sell it for $184. But if you take a look at the amount of credit that you've been able to collect during the course of this trade, you've been able to collect $865. So you're actually not doing too bad, and you get to start the process all over again. Now that you no longer own the stock, you can sell another put contract, and then you can just keep doing this cycle over and over and over again. And that's why we call it the Wheel of Fortune strategy. Now, the weekly wheel is the same thing as the Wheel of Fortune, but just with a specific time frame for the option contracts, which is weekly. The objective is to generate weekly income, which could be used as a retirement strategy. Now, let's walk through the step-by-step process for initiating this strategy. All right, so I'm going to go from a stock chart to a flow chart to see if we can better solidify this concept. The first thing we're going to do after picking our asset is to sell a put. Immediately after we sell this put, we're going to put in a good to cancel order of 50% profit. And this is what I refer to as juicing the option, which I'll get into a little bit later in this video. But if we do hit the 50% profit, we go back, sell another put, and we continue this cycle over and over again. This could happen many times. But then we could find ourselves in a situation where it does not close out for the 50% profit, but at the same time it doesn't go in the money. And in the rare event that this does happen, we want to buy the option back at least 1 hour prior to the option expiring, at which point we'll go back and sell the put. Now, if the option does go in the money at expiration, of course we're going to buy the stock at the strike price. And once we own the stock, now we start selling calls. And this process is the same, basically the same as selling the put. We're going to do an immediate good to cancel order to close out at a 50% profit. We'll repeat that over and over again as many times as it takes. If we do find ourselves in a position where the position has not closed out for a profit but has not gone in the money, we're going to make sure we close that at least 1 hour prior to option expiration. And then if we do go in the money, we're going to end up selling the stock, at which point we will go back to selling the put. And as you can see, this is much like a wheel where we go round and round over and over, printing money every time. Now, there is a fundamental flaw with this strategy that has put many traders out of the game. In order for you to avoid becoming a statistic, it's vital for you to be aware of this flaw and to adequately mitigate it. So what happens if you sell the put, the stock or the option goes in the money, you're assigned the stock, so you end up buying the stock, and then the stock plummets? The premium you collected will do little to make up for the unrealized losses that you currently have, and if the stock drops badly enough, you won't even be able to collect any premium by selling calls. All that capital you have tied up in this strategy is now locked up and your income stream has just abruptly ended. Well, I have a safeguard for that, which I call rationed capital. With the rationed capital, you're actually planning for such an event because, as history tells us, none of us can know when this is actually going to happen, and it typically happens when we are least expecting it. The first thing we have to do is identify how much capital we want to allocate towards our strategy, and then next we're going to divide that money up into multiple pots. We will initially use one pot to trade with, and then the other pot will go into the safe. If we get into a situation where our first pot gets locked up, we'll pull the next pot out of the safe and trade with that until our first pot gets unlocked. At that point, we'll put the second pot back in the safe. This is how we increase our chances of always being able to generate income from this strategy. Here are some recommendations for allocating your rationed capital. First, the conservative option. This is the most conservative option, and all you do is take your Wheel of Fortune allocated capital and divide it into thirds. This gives you 2 additional layers of protection. The next is a more aggressive option, which is where you divide your capital in half. Just keep in mind that this only gives you 1 layer of protection. So if you get bit twice, you're going to lose your income until your positions can recover. And the last is a hybrid option. So if you want to be a little more aggressive while maintaining 2 layers of protection, you can use this option instead. So in this hybrid option, your first level is going to use 5/12 of your total capital. This will give you 25% more return than the conservative option, but not as much return as the aggressive option. Level 2, if level 1 gets locked up and you then have to use level 2, you're going to use 1/3 of the total capital. Now this is going to be a 20% reduction in income from your level 1, but you're still going to be generating some income, and some income is better than none. And then level 3 is 1/4 of your total capital, which is a 40% reduction in income from level 1. But again, you're at least generating some income. So if you feel like you're in a position where you could withstand a reduction in income, then the hybrid option might be the best bet for you. Overall, the allocation structure you use is up to you and your comfort level. The more vital the income is, the more conservative you should be. But you can also make adjustments as you go. For example, if you find yourself in a situation where you've been selling puts for a long time and you've been able to drive your cost basis way down, your risk is now lower, so it could make sense to shift to the hybrid or aggressive allocation. If you're just starting out, I'd recommend starting with the conservative option until you get a feel for it. Now that we know how much capital to allocate towards this trade, we need to pick an asset that we're going to use. Here are the characteristics that we should be looking for. First, we want a relatively low trading price. This is because higher priced stocks will require more capital. For example, selling one put on a stock trading for $500 requires $50,000 worth of capital, whereas selling a put on a $50 stock only requires $5,000 of capital. This will be driven by your financial situation, so the more capital you have, the more choices you will have. But also, you want to be as efficient as you can with your capital. We also want strong fundamentals. These are companies that have strong financials. Now, you don't need to be an MBA or a finance major to be able to analyze this data. There are all kinds of websites where you can find all kinds of charts and graphs regarding the finances of publicly traded companies. But you can also find it right in the tastytrade trading platform. Now, what you're going to be looking for is an income statement with steadily growing quarterly and annual revenue and profits. And on the balance sheet, you want to see assets that are growing faster than liabilities. So let's switch over to the tastytrade platform so that I can show you where to find this information. So if you go into the tastytrade platform and you pull up the stock that you want to do the research on, the next thing you want to do is come to this tab here, Research and News. Click on that. Typically by default it's going to come to the news feed here, but you look at these tabs along the top and there is a Financials tab. Click on that. And then you're going to be able to see here the income statement at the top and the balance sheet below that. You have also over here both quarterly and annual for both the income statement and the balance sheet. And so what you're going to be looking at, and this is really kind of perfect here, we see here that the revenue is steadily increasing year over year. The net income is also steadily increasing year over year. Now there was one year, 2022, where we saw a drop off. But we got to take all of this information as a whole. It's not going to be too often that you're going to find the perfect financials, although sometimes does exist. But we're looking at this as a whole. And the more recent the data, then the more relevant it is. So if, for example, you had some bad data 5 or 6 years ago, that's not going to be as relevant as if this bad data happened last year or this year. And it also comes down to the frequency. If you're seeing bad data on a regular basis, then that's going to be less quality than a company that's consistently showing good data. So we're seeing good growth here in revenue. We're seeing good growth in income. Let's look at the quarterly. This is going to be more recent for the last year. And of course, Amazon quarter 4 is always going to be higher than the other quarters. That's the holiday season. That's where consumers are doing most of their shopping. So this is to be expected. But you can see we're seeing steady growth in both revenue and profits or net income. And then if we look at the balance sheet, we're definitely seeing the assets increase at a steady rate. We're seeing a bit of an increase in liabilities, which we typically don't want to see the liabilities increasing. We'd prefer to see that decreasing. But we are seeing a divergence in the assets to the liabilities, meaning that the assets are growing faster than the liabilities. So that is a healthy sign. And let's take a look at the quarterly results here. And again, we're seeing growth here. So we're also seeing that divergence. So this is an example, a prime example of a good, solid company with good, solid financials. Another characteristic that we want to look for in our asset is we want high liquidity. The more liquid an option is, the tighter the bid-ask spread is, which makes it easier to get in and out quickly. So let me switch back over to the tastytrade platform because tastytrade does have a proprietary indicator which shows the level of liquidity for each one of the assets. So back in the tastytrade platform here, we have the asset pulled up that we want to see the liquidity indicator for. So let me pull over, I call this I'm not sure what tastytrade calls it, but I call it the expanded data tab. So let's go ahead and open that. And if you look on the overview tab within this tab, come down just about a quarter of the way, you'll see 4 stars. And the number of orange stars indicates the liquidity of this particular asset. So here we can see it's 4 stars, and the more stars, the better. So I would recommend that you stick with assets that have 4 stars. The minimum I would go is 3 stars. I wouldn't go any lower than that. But that is a good way to make sure that you're trading an asset that has high liquidity. And then the last characteristic that we should be looking for is to look for a relatively stable stock. And when I say relatively stable, we're looking for a stock chart where the stock price is relatively stable. It's not jumping and gapping and you're not seeing wild swings in the stock price. Typically, those that have strong, steady fundamentals will also have relatively stable price movement on the stock charts. Now that we've done our initial planning, it's time to start executing. So the first thing we're going to want to do is select our expiration cycle. And since we're doing the weekly wheel, we're going to want to select the current week, unless the current week has less than 3 days until expiration. And if we look at the current week, which is February 21st, it only has 2 days until expiration. So we're going to want to jump out to the next week, which is February 28th. So that's the one that we'll select, and we can open that to look at the option chain. But the other thing we're going to want to look for is earnings. If there is an earnings announcement within the expiration cycle, we're going to want to wait until after that earnings announcement is made. And the reason is because earnings announcements are considered to be binary events that can have a significant impact on the price of the stock. And when we're selling these options, we want the stock to remain relatively stable. We don't want it jumping significantly in one direction or the other. So if we look at NVIDIA, we can see a nice handy feature that the tastytrade platform has is it tells us with a purple E and a purple line that we can expect earnings. And if we look on the right side, we can actually see when the earnings is, which is February 26th. And the little bell icon indicates that it is after the market close because the arrow is pointing to after the bell. So with this expiration being on the 28th and the earnings being on the 26th, we will want to wait until after those earnings have been announced. Now, this is just another safeguard to help ensure that we can always be generating income from this strategy. Bottom line is, it's not worth the risk, so just wait. So let me switch over to Amazon, which does not have earnings coming up. So we're going to go out to the February 28th expiration cycle because it has more than 3 days. It's the closest weekly option expiration cycle that has more than 3 trading days within it. Let's expand it so that we can talk about selecting our strike price. So keep in mind, the more premium we can collect before getting assigned, the lower the risk is once we do get assigned. But we have to find a balance. Preferably, especially on the first go-round, we don't want to get assigned because there's nothing less risky than being able to keep the premium you collected. So we want to leave a little bit of room for the stock to breathe. So it's a balance of collecting the most premium while also trying to not get assigned, at least in the beginning. So what I would typically do here is I would go out at least one strike price to the strike price that's in the money. So this 202 would be good, or possibly even the 220, just depending on where the stock is, but typically I would sell the 202. So once you have your expiration and your strike price selected, it's time to go ahead and sell the put. And as soon as you sell the put, enter a GTC or good till canceled order for a 50% profit. This will help you juice the option profits, which I will explain next. Congratulations! You just initiated your Wheel of Fortune strategy by selling a put. Now let's go back to the flowchart to see what our possible outcomes are. So if the option stays out of the money, you may have the opportunity to juice the option. Let's take a look at a stock chart so that I can explain. So let's take a look at an example. If you sold the put back here on this date and the expiration for this contract was out here, in order for you to take all 100% out of the option, you would have to wait this entire time. But what if you could close out for a 50% profit here, and then close out for another 50% profit here, and then another 50% profit here, and then once again here? If you were able to do that, you now have just booked 200% profit rather than 100% profit, and that is actually very feasible because of the cyclical nature of stocks, in addition to some other pricing components of options. It is actually quite feasible to take 50% profits throughout the duration of that particular option contract. So that's why I always close out at a 50% profit, and then I will reevaluate where I want to sell the next put. Maybe I want to move the strike price up or down a little bit depending on where the stock price is, and I will open a new position. So after we're done juicing the option as many times as possible, again, we want to be aware of the option not hitting that 50% profit target, but also not going in the money, because we want to make sure we close that out at least 1 hour prior to expiration. But then once we do go in the money, of course, that's when we're going to be assigned the stock. We will have to buy the stock at the strike price. And then that's when we repeat this whole process, but instead of using puts, we're going to be using calls. We can juice these call options the same way we juice the put options. And then the same thing, we want to make sure we watch and monitor the position to make sure that if it doesn't close out for that 50% profit by expiration, that we go ahead and close it out at least an hour prior to. And then if it does go into money, we will be forced to sell the stock, at which point we go right back to selling the put and repeat the process over and over again. Now, selling the call is the same as selling the put. Ration capital is no longer a concern at this point, but just make sure you don't sell more contracts than the number of shares you own. So if you only own 100 shares of the stock, do not sell more than one call contract. And it's important to track your credits received so that you can know what your cost basis is. You never want to sell a call below your cost basis, because that will force you to sell at a loss if your call gets exercised. The possible outcomes for a call are the same as a put, but just in the opposite direction. So the last thing we need to talk about is how to handle a large down move. So what do you do if this happens? So the situation is you sold your put, maybe the put went in the money, you own the stock. Either way, it doesn't really matter. If after you sell a put, the stock tanks, either way, you're going to be forced to buy the stock at a much higher price. You own the stock, you might find it difficult, if not impossible, to sell calls. So the first thing you want to do is just let the stock settle out. It's not uncommon for stocks to trade erratically after a large move like this, but normally after a few days to a week or so, you're going to see it settle out. And then once it does settle out, you're ready to go ahead and start again at a new level, put on a level 2 Wheel of Fortune position. So essentially what we're doing here is we're taking the next pot of capital out of the safe and putting it to work so that we can continue generating that income at the new level. If you're able to sell calls, definitely go ahead and do it. You're not going to be able to collect very much on these calls, if anything at all, but collecting something is better than nothing. And what you're going to do is continue trading level 2, just like you traded level 1, the exact same way, until the stock recovers to where you're able to continue trading level 1 again. Once you can start collecting and generating income with level 1 again, then go ahead and put level 2 back in the safe and leave it there until this happens again. Now you know how I use the wheel to print money. I hope you found it enlightening. As I mentioned earlier in this video, Tasty Trade is my go-to options trading platform. If you're interested in opening an account, I have a referral link in the description below. If you use my link, it would really help support my channel. If you have any questions or comments about today's video, please put them in the comments section below. Are you currently an option trader? If so, what is your go-to option strategy? Well, that's all for today. Thanks for tuning in. Take care for now and stay tuned for more better options. Bye-bye, everybody.